Yeah, good day, everybody. It's Patrick Downey here, President and CEO of Orezone Gold Corporation. We've just built the 16th mine in Burkina Faso, a very successful startup. We're in our first year of operation this year. Our guidance around 150,000 ounces this year, just under $1,000 all-in sustaining costs, which includes our corporate costs. We are in a major growth process now. We'll expect to put out a study in the middle of this year showing growth up to above 250,000 ounces a year. Very excited about that. So it's good to catch up with everybody and give them an update on the company and the project.
Patrick, good to see you. How are you?
Good.
Here in Africa, where it's all happening, it seems.
Yeah.
Busy conference?
Yes, very busy. We came down Friday. We've been busy ever since. We had lots of good meetings. Of course, being an African company, this is a great place to come down and catch up with a lot of the shareholders, but also a lot of the other companies and find out what's going on in the continent.
Cool. I'm going to talk about that in a minute. So we're going to set this up. We put out an analyst note recently. We asked some questions of you using the last economic study. And you're the first person who's ever come back or deemed it important enough to come back and actually talk to us and write a reply. So, hats off to you on that one. We're going to deal with some of the questions that we asked in this conversation. So we're not ignoring that. Okay? Good. So, in fact, since we last spoke, you've got into commercial production. So where are you at today? You gave some of the numbers there. So what's the position?
So we really restarted operations on the 28th of October. By the 30th of November, we were at commercial production, which for us was quite a tight schedule. But I think...
What's it mean, commercial production? A lot of people use that phrase.
Yeah. So we had laid that out for everybody, 80% of nameplate, throughput, which is 5.2 million tons per annum, so our 14,000 tons a day. And we ramped up very quickly to that. And then recoveries, our design recoveries, 89%, but we were at 92 from day one. Very, very fast leach kinetics on this. It's all oxide. So we were actually at nameplate and above recovery. So, and then we went into December and we ramped it up to over 10% of nameplate, and that's where it's been ever since.
Right. Okay. Now, I think some of the questions that we asked were around cost and the factors which define your cost. You talked about under $1,000 there. The grade and grade control, more importantly. Yeah. So can we just talk about grade control and ore to waste?
Yeah, no, absolutely. I mean, the point in the analyst note is very valid. I mean, when you're dealing with a low grade deposit, you really have to be on top of it. So when we define our reserve, it's 25 by 25 drilling. We assay every meter, and then we went into 12.5 by 12.5, which gives you 18 more data points, of which we sample every meter. Now, normally people would do, if you're mining what's called a flitch off a bench, 3-meter flitch, 6-meter bench, you would composite the 3 meters. We didn't do that. We sample every meter. Our ore body is
what's it do for you?
Oh, just very well defined data within that block.
Right.
So you're looking at every meter, of intercept. So you can model. We put everything in 3 grade bins: high grade, which is 0.7 and above; medium grade, 0.5 to 0.7, and then low grade 0.28 to 0.5.
Right. So just sticking with that waste control as it were, because obviously waste is money out, wasted money literally. So
the great part about our deposit is you're going from the hanging wall in waste to the contact of the ore. Yeah. So that's very important. So understanding that contact, where you're getting it. Bomboré, there is a visual, you can see it, but we've got, like as I said, that 12.5 meter assay. In between. So we will then set that out. The ore body at that point is dipping at 70. So normally when you're doing drill and blast, there's a throw and a heave, so it moves. But we're not, it's free dig. So we actually put what's called batten boards right at that 70 contact. The excavator face comes in, he sets his angle of his bucket at that 70, bang, you get that contact. Now, we were in a unique position. We were mining early. We'd created 5 million, 6 million tons of stockpiles. So how do you do that reconciliation? So in December, we took a part of the ore body. We looked at the reserve in tons and grade, the grade control tons of grade, which is generally a little different. We generally get a positive reconciliation on the grade control. It bumps the grade up a little bit. And then we took 3 full days of that where we stopped the mill, we flushed it out, and we mined only that, nothing from stockpiles, only that. So we had our model, and every 3 hours we took a belt cut, we sent it off to an independent lab. We have your own assays within your mill where you get your composite every 15 minutes. You're taking a sample going into the leach tanks, you're taking a sample going out of the leach tanks, you're sampling each leach tank. And from that, the grade was supposed to be around 1.08 grams. We were within 2% of that, which is phenomenal. And we were within 2 to 2.5% on the tons. And we've been seeing that throughout. So our grade control reconciliation is very tight, like really tight. And we don't worry too much on the contact between the high grade and the medium grade. We get a little bit of dilution there, no big deal for us. But we are very tight again between the medium grade and the low grade, and then the low grade out.
Right, okay. You were keen, before we started filming here, to impress upon me you doing this all through COVID and the pressures that entails, financial and stretched timelines, etc. Had a bit of an issue with energy as well in there, in the mix.
Yeah, that was unfortunate. We had signed a power purchase agreement for the life of mine with a group out of Ghana, Gensur. They were to provide us with LNG, bring in LNG. I mean, they are an established company. We're not quite sure of all the details, but obviously the LNG went to the moon.
Someone else bought it.
With the Ukrainian crisis, and they made an announcement that they sold 100% of their LNG to a third party.
Right.
And arbitrarily, our power plant stopped. And here we are, stuck with no power. But I got to tell it, when you got a team of people like we have, within a few days with our consultants, and I got to give them a lot of credit here, ECG, they're a subsidiary of Lycopodium. We located a 12 megawatt diesel power plant run by a subsidiary of Caterpillar Equipment. We were able, with the help of the Burkina government, to get that permitted to get in within 2 days. And we had it in, set up, and ready to run again within 30 days of getting the lights shut off on the 27th of September. On the 28th of October, we restarted operations, which was phenomenal.
Good effort.
Yeah.
Good effort.
Now, everybody's sweating at that point because you got no cash flow, you got $100 million of debt, you've got all your team in place, you're eating into your working capital.
Yeah.
People are thinking, oh, they're going to be in trouble. But
that's what I want to get to in all of this, because it's about making money. All of these things are about making money, right? And you've kind of got the debt load there. Obviously, we talked, I think, last time out about how you could raise the debt equity to actually build this thing out. The cost and cost control is so important. You've given us a detailed explanation on the kind of the grade element. Now you're kind of raising the grade slightly, but with the cost controls, what have you been able to do and been able to affect?
So I think, since we started everything, one thing that hasn't gone up really is labor. So Burkina does not have the same inflationary pressures around labor that you've seen worldwide in the mining business. Obviously, we pay the same price as everybody else for cyanide, lime, caustic, etc., grinding media. We don't use a lot of grinding media because it's a soft ore, so it's not a big cost center for us. So our 3 main components for this are cyanide, lime, and power. Now, obviously, when you had a fixed power rate at which you had signed, you expect, well, the power is not going to be affected. Yeah. It did. So this year, having to use diesel for a full year has added $15 million to our costs. Right. We're still below 1,000, but we would have been another $100 an ounce below that. That will be resolved this year where we are connecting to the grid. The grid now in Burkina is fully reliable. It's now connected to Ghana, got connected to Ghana in December, and connected to the Côte d'Ivoire grid, and they've got a major solar plant. So the grid costs are about 14 cents per kilowatt hour. There are 4 mines running on it now, and we will be the 5th. Kiaka will be the 6th. That will bring our cost down by $15 million, or $3.15. Other than that, we're not a million miles off of where we were predicting our costs to be. Our strip ratio has gone down significantly. Originally in the study it was 2.3, but with our grade control drilling and how we've modeled the ore body, we're down about 1.3 to 1. So for every ton of ore, we're only mining 1.3 tons of waste. So that takes a ton, away, or more or less about $1.70 away from your cost.
Right. So because we did some peer analysis in terms of their cost structures around there, we weren't sort of plucking numbers from the air, right? Yeah. So what have you been able to do that they aren't doing? Because it may be a case of, well, it may be an unfair comparison because their costs are, 50, 60% higher than yours in the region.
Not really. I think when you look at most mines in Burkina, they are hard rock. So you've got a drill and blast component, which is 90 cents. So take that 90 cents away. You park that because we don't drill and blast.
Yeah.
None.
Free digging.
Free digging.
Right.
Secondly, when there's free digging, the wear and tear in your components, like your excavator teeth, your buckets on your, they're nowhere near what anybody else is. So you're not having that component of costs in it. There's a negative to it in the sense that if I put so much volume in a truck of heavy rock, I've got more tons, so I'm hauling less tons the same distance. The one thing that was said in your report was our haulage distance are not long. Right now,
what's the cost?
The haulage cost, you're around about 11 cents per ton kilometer is more or less what we're paying for haul.
Okay.
And we divide it into buckets. So if you're right beside the mill, that's built into your unit cost with your contractor. If we're more than 3 kilometers, there's an extra little bit. If we're more than 5 kilometers, and we don't go into, we just block it. He agrees to it, and we know what tons come from where. Right.
Okay. So, and then next important conversation here, which is you've talked about the moving from number of ounces you're at now to 250. That's a big leap up. You're a contractor. You've got a contractor in place right now. Does that make you think twice about using contract versus in-house?
Yes,
right.
Definitely. So more to the point, I think where we would look. This is a local contractor. Yeah. He can cope with free dig and all of that good stuff. We would certainly contract the drill and blast because that's very well established in Burkina. There are 2 other major contractors in country that can do hard rock that Endeavour use, that other companies use, that are decent contractors. But we are going to do an internal, look at whether we would go with our own mining fleet or not. But then you have to establish your own workshops, you have to establish your own maintenance crews, all that other stuff.
Right.
But what's really happened with the expansion was the discovery at P17, a totally new type of deposit. We're now seeing it in other parts of the main zone. We've had now 100,000 meters of drilling that's not included in the 2019 resource, that will be included in the update.
Okay.
And it's really focusing on the high-grade sulphides, and we found a lot of them because the previous management...
Where are we in terms of the ore body?
The ore body, we're only down... oxides, average depth of 35 meters.
35, right. Really super shallow.
Yeah.
Sulphides?
We had the average depth of drilling on the M&I, which can only go into reserves, was about 70 meters, so very shallow. The reason they stopped was because the previous management wanted to build a heap leach.
Yeah.
Cheap capital, that's the way they thought. We completely changed that thinking. And now it's pretty obvious by understanding the geology, we can add to the grade significantly. So you're looking at something that I would expect would be 1.6 to 2 grams sulfide with a strip ratio of 2 to 2.5 to 1. And just to put that in context, Matt, Hyundai, which is a mine in Burkina, run by Endeavour, and they're very transparent about their costs, that would do 1.6, 1.7 grams per ton, 8.5 to 1 strip ratio, all in sustaining cost about 870.
Okay.
And they're on the grid.
Yeah.
We will be on the grid as well.
So the hope is to kind of drive it down there. So let's talk about nameplate capacity and increasing capacity from the current setup, right? Because one of the kind of the questions for us was around seasonality, rainy season, freaking nightmare, right?
Well,
how do you work around that?
People seem to forget we started mining in 2021. We had to mine out 10 million tons of a pit, which is why we've got 5 million tons of a stockpile. It was a 1-to-1 strip ratio to store water. We've gone through 2 rainy seasons. We've got a pretty seasoned team of people who worked in other mines in Burkina and in the region before.
Right.
We always drop our throughput rate. So let's say we're showing 5.2 million tons to the mill. We always drop the throughput during the rainy season.
Right.
You don't get, in Burkina, you don't get like in certain areas, maybe at Côte d'Ivoire, more coastal, you get heavier 3-4 hour showers. We generally would get an hour and then it'll dry out and we cope with that. But you will get rain events and it's almost like Canada where you get heavy snow. You stop everything.
Well, because it's not just the mining component; it's the transportation. Trucks, roads being wiped out, and all of that kind of stuff.
No. If you're not prepared for that, you don't know what you're doing.
Right. So how does it work?
All our roads are above the drainage system. We laterite coat everything, compact it, crown it.
Okay.
We crown it. We maintain it. And particularly for the wet season, making sure that.
How much are you spending on that?
Oh boy, per kilometre, I couldn't necessarily tell you. It's less than $1 million a year.
Right,
it's not a big number, and we've got our own laterite pits.
Right.
So you have to have that. If you don't have that laterite sheeting, you don't have that. Yes, things will start doing this. And again, it's hiring people who know what they're doing, done it before, been there, etc. Wide roads. We didn't cheapen up on our roads. I got to tell you, we had 2 massive events last year when we were mining, and things are happening in the globe as we know. And I got to give praise to our consultants, Knight Peacehold, who did out all the site water management. We cope with everything that was thrown at us in terms of site drainage and things being diverted and moving out of the way, etc. So that's super important.
Site sorted in terms of the because it can be traumatic, right? It can be disruptive. So the site's fine, and the roads that you utilise are fine for around $1 million, as you were saying.
Yeah, but we always drop, and that's part of your cost. Right. But we always drop the throughput because there will be times. Sure, so we will always have about 1 million tons of stockpile sitting right at the plant feed.
So what does that production profile look like? And how many months are we talking dropping production by?
The really 2 months of the heavy rainy season.
Right.
So you're really looking at July, August as being the rough months.
Right, July, August, and a lesser effect either side of that, and then the rest of the year you make up the balance. Right. Yeah. Okay. So back to the question about increasing nameplate capacity around that. And so you're talking about significant increase there. How much additional kind of CAPEX? Because the problem with a lot of mining companies, they keep plowing the money back in the ground, they're plowing money in the equipment, they kind of forget to make money. So for you guys, been there before.
So we will. It's a what's called a brownfield expansion. We will go to approximately 4.3 million tons per annum extra expansion. We'll be mining from slightly different pits. So when we're mining the oxides, we're preferentially mining the pits that we want to expose the sulphides that we want to go after. P17 is totally different.
Defined by how? What do you know?
Grade.
So grade meaning what? What are you chasing?
1.3 and above.
Okay. But average?
1.6.
Okay.
But P17, there are no oxides, so we're into the sulphides right away.
Right.
So that's the main feed for the sulphide plant. Okay. Then Siga, which has got about 25 meters of oxide, and then Maga Hill, which has got about 35. We've discovered something new in P8, P9. We're going to put results out on that in first quarter of this year. That will add to the sulphide profile. It's a bit deeper, about 70 meters, and that's the thickest oxides that we have. So we'll get to them probably in 2027, 2028.
Okay. So on this forward guidance that you're talking about in the market, how do the economics change?
Well, first of all, you're going to have slightly different mining costs because you have drill and blast. You're going to have higher processing costs because you're crushing and grinding. I would say if you look at Hyundai, about $11, that's sort of where we should be at. I mean, we know our cyanide consumption. We've done the test work. Our recoveries will be 90 to 96%. It's free milling, so there's nothing particular. 75 micron grind, so it's not a fine grind. Cyanide consumption's not heavy, so there will be some savings on G&A because now you're still running your oxide. You're going to be running the sulphide, so your overall G&A per ton. You save some there. I would say, all in on the sulphides would be, at a 2-to-1. Let's be conservative. Call it 3-to-1 strip ratio. Your mining costs would be, all in about $12 per milled ton. Call it another 12 for processing, 24, and maybe 2.5 for G&A.
Right.
Sustaining CAPEX for that size plant on a sulphide, I would expect it to be $6-7 million a year.
Okay. So let's talk about the balance sheet then. You've got a few variables that you talked about in terms of cost per ton. Let's talk about it in the context of your balance sheet and managing that. So you've got a current outstanding loan which you're paying down, right?
Yeah, we will pay down $33 million this year.
Right, leaving you with what?
59.
59. Okay.
So not a heavy debt.
Right, and to be paid down over what period?
3 further years. So by the end of 2024, we'll be around about 35-40 million of left,
right.
And that's when we need to build the mine. So
right,
we would expect
to be able to refinance that out.
Correct.
Okay, with the same people,
yes,
or
we're very
because it's all local, right?
Yes, we're very comfortable with them.
Or regional, I should say.
You don't require political risk insurance, which is 1.5 to 2% cost of capital.
Yeah.
They don't require gold hedging, gold prepays. It's very clean debt.
Right.
We would say it's provided that they're reasonable in terms of interest rates and things. We would be.
Well, your risk profile also changes. It's better because you've been paying down for 2-3 years anyway. So one would hope that is the case,
correct.
But God knows what's happening globally. But give us a sense of the CAPEX component and any other factors you've
Great question. So what we plan to do right now on the 5.2 million ton per annum, we've got certain tank sizes. We're absolutely duplicating that.
Right.
So the same tank size, same agitator, same pump, same will be there.
And same skill sets required to run them. People know what they're doing. Okay.
And so we'll build that ourselves.
Okay.
We don't need anybody to,
right.
We don't need anybody to help us order that equipment.
Yeah.
It's the same
But
guys.
you've named some pretty big, heavy stuff there a few seconds ago. So what's that costing you?
Well, the overall plant itself, I expect to be between 170 to 185 million.
Okay.
Everything.
Right. And you would do, given the debt structure which you managed to do for this first phase, you would look to amortize that over what period and pay that down over what period?
Probably 5 years.
Okay, so fairly quick.
Yeah.
Right, and what's the life of mine in the new scenario?
It'll be another 14 years from when we started up.
Okay.
So let's say we started up in 2025, we'd have about 14 years of mine life.
And the driver to pay down within 5 years comes from the lender. You would love to amortize that over?
Well, there's 2 reasons for it. I think we know there's a lot more ore there. We could probably build a bigger plant, Matt, but we look at it, what can we afford to do and how do we not blow up our balance sheet and everything else that goes with it.
Fun ones last year.
And so, we're looking at it sort of like how B2 approached Fekola. We'll put one part of it in, but we'll leave it, it's a typical LICO design, so a large SAG mill. But if we want to put a ball mill in 3 years from after that, we can put it in and go to 8 million if we want, and you just add tanks. So that's how we're trying to not overstretch our balance sheet.
Okay. Which is super, super important because we saw a few things blow up last year globally, and it's an important question to answer, okay? Now, that's the kind of expansion component. You said 14 years life of mine, you could have shrunk that down and made a shorter life of mine, bigger output, or you can go the other way, do a ton more drilling and try and see if you can extend the life of mine.
We will do that. I think our current pits that we're looking for this expansion are only down to about 200 meters, which is still reasonably
Have you
shallow.
drilled a bit deeper than that before?
We have a few holes below that. We know it continues, but we had a limited budget in 2022 because we're building a mine.
Yeah.
We were lucky to be able to drill. Most banks won't let you drill. So we just focused that drilling on defining those resources from about 50, 60 meters down to a 200. And we're very happy with what we've seen. We've put the results out to market. We have another set of results still to come out. But, we're still wide open beneath that. And I'll give you an example of that at P17. We targeted a hole to see if there was an extension of the system, and we hit 12 meters at 10 grams. Now,
that's a very different profile. Yeah.
But we're seeing that at P17. I'm telling you, our discovery hole in the extension was 30 meters of 4 grams, 25 meters below surface. This is a whole different beast now. We're building the model. The model's not out in the market yet.
Yeah.
But I like what I've seen.
And that's a whole different set of challenges for how you process that at the current mill. But
no, the current mill is we will not use the current mill. I want to look. The oxide mill will remain the oxide mill.
Okay.
We will not mix oxide and sulfides.
So this would be
literally the oxide mill sitting here, the sulfide mill will be there, and only thing that will be common will be the gold room and the gold recovery circuit. Right. And all the reagents. Same reagents used, so we don't double up.
You use the same infrastructure, but the processing component will be a separately
totally
funded,
separate,
independent line item on your balance sheet.
So if I'm doing maintenance on the SAG mill for the sulfides, I can still run the oxides.
Yeah, okay.
If I'm doing something on the oxides, I can still run the sulfides.
Right.
They're two parallel circuits.
Okay, fantastic. Let's talk about the conversations you're having here at this show. We started. We mentioned it at the beginning, right? You just built a mine. You're throwing off cash here. You've got nothing to prove to anyone. So why even here?
Well, so obviously the first thing is meeting shareholders and meeting new shareholders. Hopefully, we look at ourselves and we benchmark, say, against people like K92 or Orla. They're doing less ounces than we are. Sort of the same cost profile. Our expansion is as good as what they're looking at in a lesser time frame. Both those companies are sitting at about $1.7 billion. I'm sitting at 450. Now, there may be a management discount, and I'm sure there's a Burkina discount, but it shouldn't be 3-1.
Well, so it comes down to like margin, right? For K92, very different grade profile, and they're do you know what I mean? So it's like
look at margin. Don't look at grade.
But that's what I just said to you. That's what I want. Let's look at margin. I'm not interested in grade.
Correct.
So it's about making money. I said that right at the outtake here. So,
absolutely.
So different profile, but same outcome when it comes to dollar signs, right? Mm-hmm. So is that's the kind of theme I've been talking about this week with companies. Stop talking about grade. Show me the money. But what are they asking you? What are they asking you to get focused on?
Well, I think that, really our focus in 2022 was building a mine, making sure that we got it built on time, on budget, making sure that it started up correctly, because one of the key things that people don't seem to understand, a 6-month slow ramp up with issues and mistakes is more damaging than going 10% over in your capital.
For sure. The cost of capital is brutal.
So
yeah.
I'm extremely proud of the fact that we were at commercial production in 30 days, and 30 days later we were over nameplate. So we've wiped those concerns out of and we know that we've got the team that can run and build mines. Our focus now is where do we go from here? Obviously we've got internal growth or organic growth, but we're looking to build a mid-tier here. And one of the best places to do it is West Africa. West Africa is the #1 gold producer in the world. Mm-hmm. It's the #1 ounces found per meters drilled in the world. If you just take where I am, for example, there's 2 junior companies. There's little old Orezone and there's West African. Between both of them, 20 million ounces of M&I. By 2025, 26, that region, little spot there, will be producing 800,000 to 900,000 ounces per annum of gold. So this is a great place to find and develop mines. And you can get them permitted and you can get them built, and they seem to be built on budget. You look at Canada or South America, if you create a mid-tier, you're generally buying somebody else's, I don't want those mines, can you find somebody that might like to buy them? And they're constantly chasing their tail with costs, or they're constantly going back to the market looking for more money. We don't want to do that. We want to look at this, and we think there's real opportunity in the West African region to do that. Endeavour, very successfully done it. Perseus, very successfully done it. A number of others. And we think they're sort of moving up the food chain. And there's other opportunities to pick off those 100 to 150,000 ounce a year producers that are meaningful to us. So we can get to the 400,000 or 500,000 ounces a year. But we see that time frame in a sort of a 5 to 7 year period.
Okay, Paddy. Appreciate you coming in and talking through that. And I'm going to say something to camera here, which is, ladies and gentlemen, this is how you do right of reply. I do appreciate it. And you're the first one that's ever done it. Most people run a mile. So, good man.
Look, we've always been known as a transparent company. I mean, it's sort of funny, we just met with our banks and they said that the reports that we provide them are like phenomenal compared to anybody else. You know, the thing about us, Matt, is management and board are huge shareholders in this company. And we like to do things right because it affects our bottom line.
You'd be surprised. People are picking up the salary, not worried about the bottom line. Paddy,
have you looked at what my salary was?
Okay, do you even take one? Paddy, genuinely very good to see you. Always good to see you. And I really appreciate you coming in and picking us up. I've no problem with that.
Yeah.
We will check out everything that you've said, and we'll put something out to the market which restates our position on this one. So.
And I can say, just tell the viewers here, we've started off 2023 gangbusters. We are running 10% minimum over throughput. We've had a phenomenal January. We're really looking forward to doing our Q1 production to show just really where we're at and how well we're doing.
Good man.